Hello and welcome. Today's stock analysis is going to be Palantir. During our stock analysis, we're going to explore the key pillars, examine the ownership, look back at past results, we'll find out what the analyst predictions are, as well as giving the business a valuation, and examine the potential return on our investment, and finally we will summarise our findings. Let's start by looking at the key pillars for the trailing 12 months. In the book Rule 1 by Phil Town, he suggests that these are the key metrics when first evaluating a business. The first pillar we are going to explore is the earnings per share. This is where we take the net income and divide it by the shares outstanding. For Palantir, this is a wonderful 150% increase since last year. Now let's look at the free cash flow, which is the money a business can generate from its operations. Here we can see that Palantir has made some significant gains as their free cash flow is up by 255%. Then we come to the next pillar, which is revenue, and this tells us how good the company is at generating income before deducting expenses. Palantir has only managed to increase this by 2%. Book value is calculated by subtracting the total liabilities from the total assets, and this indicates the equity growth for the company. So, as for the last 12 months, Palantir's book value has grown by 18%. Now we want to turn our attention to the management of the business by looking at the return on invested capital and the return on equity. These two measures allow us to assess a company's efficiency at allocating capital under its control. Return on invested capital and return on equity are 6%, and these were negative for the last 5 years, so this is looking much healthier. Now we move on to debt, and Phil Town prefers a company that is able to pay off debt with their free cash flow within 3 years. In Palantir's case, this is excellent as it's 0.32. In this next section, we will now focus on other key metrics which will help define an excellent business. Now let's look at the gross margin, which is the amount of money a company retains after incurring the direct costs associated with producing the goods it sells and the services it provides. This is an amazing 80%, and this is double what I would consider the minimum standard for a company. Next we come to the operating profit margin. This tells us how much profit a company makes on a dollar of sales after paying for costs of production, such as wages and raw materials, but before paying any interest or tax. Palantir's operating profit margin is 5%, so we'll explore this a little bit later in the video. For Terry Smith, free cash flow yield provides a more realistic view of a business's financial health and profitability than traditional earnings or dividend yields. It's based on the actual cash a business generates rather than reported earnings, which may be subject to various accounting adjustments. He typically looks for a company that has a free cash flow yield of 5% or higher. This is 1.36%. But it is up by 244% since last year. After that we come to the PE ratio, which Peter Lynch believes is a key indicator when evaluating if a company is under or overvalued. The PE and enterprise value divided by EBIT seem incredibly high, but this is pretty much the same for all relatively new companies as they rapidly expand and increase growth. Having looked at the key pillars, let's give Palantir a score. I've given earnings per share, free cash flow, book value and gross margin full marks. Return on invested capital, return on equity and free cash flow yield half a point each. But the rest of the pillars no points, which gives Palantir a score of 5.5 out of 11. If you're interested in reading the annual report, I've included a link in the description below. Palantir has a large market cap, and Morningstar believe they have a narrow moat, as they only own about 2% of the big data analytics market. Now let's look at the ownership. There are currently 6 super investors who own this company. If we look back at Cathy Wood's previous sales and purchases, we can see she's sold off about 37.5 million Palantir shares, but over the last year she's bought back about 12 million shares, making up about 1.5% of her portfolio. However, 2 other super investors have sold shares in Palantir. Ray Dalio over the last 2 years has bought about 1.4 million shares, but has sold 1.2 million of those shares. Now we look at the past historical prices of the company, as this will help us build a picture of periods of success or failure the business has been through. As we can see, Palantir first became a publicly traded company. Its average share price was about $25, and it fell sharply as low as $6 last year. Only now is it starting to show signs of good improvement. Only time will tell if this year continues the trend of an improving share price. So let's see what the analysts think. On average, the analysts think that Palantir is a little overvalued, and the consensus is that Palantir is a hold at the moment, and the average price target for the company is about $17. Analysts also believe that Palantir will grow on average about 30% in the next few years. Let's use a growth model to build the valuation. So I will use the current earnings per share of 0.09 as my starting point when creating a valuation. I'm going to use the average analyst growth forecast of 30%. I'm going to give Palantir a PE of 100 as it's going to take quite a lot of time to reduce it down from 257. After that, I'm going to project these numbers forward by 10 years. This gives me an estimated future stock price of $123 per share for its future share price. We then need to include a 15% return and work out the current value that Phil Town calls the sticker price, which is about $30. And finally, we're going to apply a margin of safety, and in this case it's going to be a generous 50%, which gives us a buy price of $15, which is about $8 under the current share price. If we look at the revenue and expenses chart, we can see that 88% of the gross profit goes on expenses, and this is because Palantir are looking to increase revenue by advertising its range of products. In this next section, we're going to split the chart into different zones. Our first zone is what we can look back at as being the market bottom for Palantir, which was about $6, and in this case will represent our margin of safety. After that, we identify zone 2 being between $14 and $20, and we currently seem to be in zone 3, which starts at about $20 and goes up to about $29. And finally zone 4, which I think for Palantir it has the potential to go up to $100 over the next 8 to 10 years. In this graph, we're going to compare the operating profit margin of Palantir, The Trade Desk, Datadog, Cognizant and CrowdStrike. By comparing the operating profit margin, we can see the relative performance between Palantir and its main competitors, and this means Palantir are currently lagging behind most of its rivals. In this next graph, we compare the return on invested capital, and we can see that Palantir are rapidly catching their rivals. With the exception of Cognizant, the rest of the companies are relatively new and therefore have very high PE ratios. In this next section, we find out what our potential return would be if we bought at today's price of $23 and when the price was at $7. If the share price was to hit the 52-week high of $28, then we would see a return of 22%. Whereas if we had bought Palantir at $7, you would see a return of about 300%. Finally, let's summarise what we found out about the company. When reviewing the key pillars, Palantir scored 5.5 out of 11. Under ownership, 6 super investors have bought in the last few quarters, and we found out that just 2 either sold or reduced their share allocation. In the last 2 years, we can see the average share price has trended up, but it's only just getting back to the prices it was previously. Whilst analysts believe that Palantir is a hold at the moment, they are predicting they will grow on average 30% over the next few years. Using the growth valuation model, my personal buy price would be about $15 per share. My final overall rating is 2.5 stars out of 5, and I have given this a category D rating within my own stock watch list, due to the infancy of the company and the risk that is associated with a business that has to beat off fierce competition in order to get the greater market share. Thank you for joining me during this stock analysis video. As I'm a relatively new channel, please consider using the comments section to help me develop the content I'm creating. And lastly, if you've enjoyed the video, it would be greatly appreciated if you could like and subscribe to help the channel grow.